From the world of politics.
I've been strong on border security, and I've stood up to Democrats when they're wrong on this issue.
They said they were trying to codify rote. No, it was so much more extreme than that.
To the world of business.
We still have job openings. People are still looking for work. Obviously, we'd like to see the participation rate a little higher. I mean, that number went down a little bit this month. I think 0.1%. So we have to see what's happening there.
This is Balance of Power with David Weston.
From Bloomberg World Headquarters in New York to our television and radio audiences worldwide, welcome to Balance of Power. We're going to start today with those U.S. jobs numbers out this morning. Those are the last jobs numbers before those all-important Fed meetings coming up in the beginning of November. And to take us through the numbers, welcome now Michael McKee. He's Bloomberg International Economics and Policy Correspondent. So what about these numbers?
Well, excuse me, David. You know, we have upstairs fortune cookies, and I opened one and it said, could be better, but good enough. And that kind of describes the jobs numbers today. 263,000 jobs added to the country's payrolls in the month of September, down from 315,000 in August. The unemployment rate, though, falls to 3.5%. Participation rate, as the secretary said, dropped a tick to 62.3. Average hourly earnings, good news, 0.3, same as last month, and it drops the year-over-year number to 5%. Still a healthy gain, but down a little bit. The conundrum is the unemployment rate. How come it went down? Well, we did lose 57,000 people from the labor force after gaining 789,000 the month before. But it's employment up 204,000, while unemployment fell 261,000, a swing of almost 500,000 jobs in the economy. And that pushed unemployment lower, not just for everybody, but particularly for some of the minority groups that had been struggling, blacks and Hispanics. The number that matters to the Fed is going to be what happens to inflation when you see unemployment fall. In this case, relatively good news. Unemployment going down, the participation rate going down, and the average hourly earnings number going down. So the Fed can at least take some comfort in the idea that it is on the right track, even if it's not getting to the station yet.
So, Mike, let me ask you, everybody's looking for a loosening, so-called loosening in labor markets. Do these numbers indicate any loosening at all?
A little bit, not a whole lot. What we're seeing is labor force falling. It should be rising if we really wanted to see things loosening, but the participation rate is falling. And if that keeps happening, the Fed has something to think about.
Okay, thank you so much to Michael McKee for taking us through those numbers. Now we turn to an economist to try to explain what they mean and what they'll mean for the Fed, most importantly. Megan Green, she's senior fellow at Brown University and chief economist for the Kroll Institute. Megan, always wonderful to have you on. So as best you can figure, how does the Fed read these numbers, do you think?
Yeah, so I don't think this is going to change anything for the Fed, least of all because we'll get more CPI data next week, and that will have an impact on the Fed as well. But, you know, if we were going to have a soft landing, this is what the jobs report would look like. The problem is that if we were going to have a hard landing, this is also what the jobs report would look like, because every hard landing starts off as a soft landing. So I think the take-home message is that, you know, the labor force is loosening a little bit. It's still incredibly tight. We're seeing that not just in the jobs report, but in other employment data, the JOLTS data, for example, the ratio of openings to unemployment. That's showing that there's a bit of loosening, but from a really tight labor market. So there's a ways to go.
So, Megan, if we take the Fed seriously in their 2% range, I think we have to believe them, take them at their word. What sort of unemployment do economists think we need to have in order to get down to 2%? I assume we can't do that without more unemployment than we have now.
Yeah, I think that's right. Unemployment's going to have to go up. It's at 3.5% now. The Fed itself thinks that it will peak around 4.4%. I think that would be fantastic, but is probably unlikely. I also think it's unlikely that the Fed will manage to engineer a soft landing, though. So I expect unemployment to rise higher than 4.5%, possibly even higher than 5%, which, you know, suggests that there's going to be a lot of pain for a lot of people. And of course, Chair Powell has been providing that message that they're tightening. They'd like to generate a soft landing, but it's not going to be painless. And they've done the sort of calculus on whether that's worth it or not, and have decided it's worth having that kind of pain than waiting and having to hike even more in the future and causing even more pain. So, they've been clear that they know that this will be painful for a lot of people, but it's probably the lesser evil.
A pretty direct factor in the inflation, of course, is the wages paid, and that's remaining right up about 5.0%, I believe, year over year. I've also read some suggestion there's some indication in things like the ECI numbers, it may keep going higher. What do you think?
Yeah, so it may keep going higher just because the ECI numbers are more inclusive in terms of what they're measuring. But the fact that they're not, that they're not rising as quickly as they have been, I think is cause for comfort. So I think that the wage growth has always been the most important piece of the jobs report, has been for years, actually. And so the fact that wage growth is strong, but not accelerating at the same rate it has in the past over this pandemic, I think that's probably positive. Also, if you look at the breakdown on the jobs numbers today, in the sectors that had the biggest jump in new jobs were low-wage, low-hour sectors, which does suggest that the labor force participation rate has recovered a lot. But it's probably continuing to recover as a lot of people capitulate and have to go back into these low-wage, low-hour kind of retail, restaurant, healthcare jobs that they just didn't want to do over the course of the pandemic and now are having to go and jump back into.
And a couple of points perhaps we should make here. As I understand it, the black employment actually numbers are doing quite well, back to like 2019 levels, and also underemployment is doing better.
Yeah, and this is important for the Fed. Of course, they've changed their mandate insofar as they're not just interested in overall employment, but inclusive employment. And so that's certainly something that they're looking at. I think the Fed has been very clear and very different from Feds that we've seen in the past for saying, we want to cause a soft landing, not a hard one. What we don't want to see is high inflation and also unemployment jumping up. We don't want the most vulnerable parts of our society having to pay for this twice. And that wasn't a message you heard, for example, during the Volcker days. So I do think that what we're seeing is a different message coming out of the Fed, that inclusive employment really matters.
So, Megan, you haven't told me this, but I suspect you're sick of being asked about long and variable lags. But I have to ask you, how long and how variable? Because part of the problem here, I think, for the Fed is it's not like a very carefully calibrated thing. There's a lot of momentum in this system.
Yeah, I've been asked a lot today if I'm surprised by the jobs numbers and by the fact that the labor market hasn't deteriorated much more quickly given how aggressive the rate hikes have been. And the answer is no, I'm not surprised. It takes a while. Now, how long is a great question, David. If I had an answer for you, I'd be up for the Nobel next week. But we don't have a specific measure, unfortunately. We just know it takes a while. So, it could take a year. I think also interestingly for the US economy, more so than other economies, there is a massive cash buffer throughout the economy among corporates and also among households. So how long is it going to take for the economy to turn over and really push into a recession? I think we're going to have to burn through some of that cash first. So I think it will take longer in the US than other economies. So, I expect that we'll see a real deterioration, in the middle of next year, which is probably a bit later than a lot of other economists, but it's because of that cash buffer.
Megan, it's great to have you with us, as that always is, I must say. Megan Green at the Kroll Institute and also Brown University. And now we're getting some breaking news that just came across the Bloomberg. A Credit Suisse unit apparently is drawing some attention now from PIMCO and Centerbridge, specifically the Securitized Products Group. And we turn now to our colleague, Shonali Brasek, who really reports on Wall Street for us. What do we know, Shonali?
Listen, David, this is a complicated group to be sold, but it is a very important group, and you are seeing Credit Suisse shares really jump on the back of Bloomberg's reporting here. The reason it's important is because if Credit Suisse is able to sell the securitized product group to a group of potentially interested bidders that is growing, now we've reported PIMCO and Centerbridge. We've previously reported Apollo, BNP. In my own reporting, I know there's a lot of buy-side shops that's at least taking a look at this thing. Then it could help Credit Suisse really shore up a little more capital there and stave off a more damaging capital raise. Shares now up even more, over more than 7% on the day. Now, remember, this is a business that ties up a lot of capital. Even though it has made high profits for Credit Suisse in the past, it can be risky. What you're really seeing here is a lot of firms on the buy side saying maybe a business like this is better held in private capital markets rather than in a big regulated Swiss bank.
Okay, thank you so much, Shonali. I really appreciate you jumping in with this. We'll keep you apprised of this story as it develops there. That's Shonali Brasek, who reports on Wall Street for us. Coming up, we're going to talk housing at a time of 3.25% mortgages with Tom Shapiro of GTIS Partners. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. To keep you up to date with news from all around the world, we welcome now Lisa Mateo here with the first word. Lisa?
Thank you, David. Well, hiring showing no signs of slowing as U.S. unemployment rates reach a 5-decade low at just 3.5%, setting the tone for another big interest rate hike from the Fed. Non-farm payrolls increased 263,000 in September after a 315,000 gain in August, led by the leisure and hospitality and healthcare industries. That's according to a Labor Department report released just a few hours ago. Meanwhile, average hourly earnings rose firmly. Russia sent a letter to Sweden demanding its state-owned gas company Gazprom be included in the investigation of the damage to the Nord Stream gas pipelines. The newspaper Expressen reports the letter is currently being processed with Sweden's Ministry for Foreign Affairs and comes just a day after Swedish public found that 2 Nord Stream leaks in the country's economic zone were caused by detonations. Calls are growing in Thailand for a national crackdown on drug cartels and guns. And that comes a day after a former police officer involved with guns went on a killing spree that left 36 people dead, including 24 preschoolers. The United Nations says Southeast Asia's organized crime economy, including the illicit trade in drugs and wildlife, was worth an estimated $130 billion in 2019. And here in New York City, Mayor Eric Adams has declared a state of emergency over the city's migrant crisis. He says more than 17,000 asylum seekers from Central and South America are straining the city's resources. Adams says by the end of the fiscal year, New York City will have spent more than $1 billion on the crisis. He's directing all relevant agencies to set up humanitarian relief centers to provide assistance. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Thank you so much to Lisa. Well, as we all continue to look at the U.S. economy and figure out whether it's slowing down, and if so, how fast, one of the key factors, of course, is the housing part of the market. And that is particularly reacting to the increased mortgage rates. Welcome now, Tom Shapiro. He's GTIS Partners President and Chief Investment Officer. So welcome back, Tom. Great to have you with us. So we're up to 6.75% is the last time I checked on the mortgage rate. What does that do to the housing market?
Thanks, David, so much for having me. Look, the housing market is tremendously decelerating at this point. Sales are off tremendously. Just to give you statistics from our own portfolio, we back a lot of home builder construction around the country. We do both land development, home building, et cetera. And we, in the beginning of the beginning of the pandemic, prior to it, we were at about 4 per month per community. During the pandemic, with 0% interest rates effectively and huge stimulus, we went to 6 per month per community, and now we're at 3 per month per community. So it depends on how you look at it. We're down now 50%. The last time I was on last month, I said we were down about 40% from the peak. So we're either down 25% from a normal market or down about 50% from where we were when we were sort of overproducing. So, but look, I think, when you have to sort of think through what this all means, as I said before, certainly the demand shock is coming, and that is, things have just doubled in price. So if you look at what a home costs, not only have home prices gone up tremendously, 20+% in a lot of markets, you're also seeing interest rates doubling. And so that's a huge strain on a consumer that's already tapped out, is seeing inflation all over their portfolio. So it's a lot of issues for them, and things are starting to slow down. So, but on the same sense, I just don't see the supply side coming in as we had in the past. So during the GFC, we were overproducing. We were producing 2 million homes, for example, in 2005 into what then became a huge demand shock. So we have been underproducing, and I'm still seeing about 1.7 million housing unit shortage. And the other thing you have to think about is that if you were a homeowner, you're going to be hard pressed to sell your house unless you have a real financial issues, given that the average homeowner now has an interest rate of about 3.4%. And generally that's on about 95% of those are on fixed terms. And now you're trading that out for, as you point out, around 7% mortgages. So you're not going to see a lot of selling. I think we're just going to see a very slow market right now. Houses pricing is generally sticky on the way down. Sellers don't want to sell at depressed prices. Buyers want to buy into the new pricing paradigm. So I think we're just going to see a pretty slow market right now. And home production is coming down tremendously. And I think we're going to see home builders pulling back.
If I'm in the market for a home, I have to worry about the mortgage rate, presumably, if I'm going to buy, but not so much if I'm going to rent. Are we seeing a substantial shift in between buying and renting?
Yeah, David, that's a great point. I mean, right now it's about $820 per month cheaper to rent a house and to own a house. So we are starting to see a buyer preference towards that. And that's why, as I mentioned in the prior markets that we've been on, we've been really focused on the single family rental business. We sold off our scattered homes and we're now building whole communities of build to rent single family homes. So that would be a 200 or 300 lot subdivision, all of which are rental homes. So we're very focused on that and we're still seeing demand. But rents are starting to have gone from up, 12, 13% across the country, 20% up in some markets, to now it's starting to moderate. We're actually starting to see rents start to decline, particularly in the multifamily market. Single family hasn't come down as much. I think it'll be stickier, but it is softening. And one of the things that's driving that is household formations have started to come down. And so that's something we really have to watch, because that's what got us into a lot of problems in the GFC. We generally produce 1.2 million households per year. And during the GFC, that dropped in half. And that was just at the time when I mentioned before that we had tremendous supply coming into the market. And that's what caused this unbelievable housing explosion during the GFC. So I think we have to watch household formations that come down just moderately, given that the consumer is now much more nervous than they were in prior months. And so we have to see where that goes. But for sure, as you point out, renting a home right now is better than buying a home in most markets.
And whether you're renting or buying, to what extent are we seeing shifts geographically? Because certainly anecdotally, it felt like a lot of people moved because of the pandemic.
Yeah, I mean, it's a great point. I mean, we're starting to see, and we continue to see out-migration, particularly in San Francisco, which is down about 7% of the population is left. And that's really a troubling number. And they obviously have to get their hands on all the issues that they're having right now. New York is not far behind that. So, we are seeing an out-migration out of the major cities into a lot of the Sun Belt markets, the markets like a Charlotte or a Dallas. We're still seeing Austin. We're seeing a lot of job growth in those markets. And that's where we've been focusing our investments over the last couple of years. So, there is definitely a geographical preference, and some markets will do better. And I think there'll be a big differentiation between the different markets.
Tom, finally, let me make a big shift here. You have a lot of businesses, I understand, in Brazil. Obviously, there's an election coming up. That economy has been challenged, although I'm told it's maybe coming back some. What's your business looking like right now in Brazil? Yeah,
really interesting. The office market has done surprisingly well. In the Faria Lima district, which is the equivalent of Park Avenue, is extremely low. Brazilians actually have a real return to work policy. And a lot of them are in very small apartments. We built 4-bedroom apartments that are about 800 square feet. So most Brazilians don't want to work out of their apartments. So we're seeing a real return to work. So we're seeing very low vacancy rates. Also, for office, we're actually going to start a 600,000 square foot speculative office building in Faria Lima. Industrial is doing quite well. We're seeing they're about 4 years behind on the e-commerce side in Brazil, so we're seeing a lot of demand there. Housing's been a little mediocre. The affordable stuff's done well. The higher end stuff's been pretty slow. Hospitality's been very tough, and now coming back tremendously. So we actually like investments in the hospitality sector, right. Last mile logistics, and we're also focused on development of office in certain markets like the Faria Lima region.
Tom, one last fast one here. Given what you just said, is there a big difference between Brazil on the one hand and the United States in terms of return to office? Because it looks like some parts of the United States is not coming back to the office. Is that your experience?
Hugely. I mean, Brazil is like 80% back to work. So it's much different than we see in US or Europe. So it's just, I think, a cultural thing, and Brazilians like to be together. And so we are seeing a really big differentiation between Brazil and the United States.
That's fascinating. It's always great to have you with us on these housing questions. Thank you so much to Tom Shapiro.
Great.
He's GTIS
David,
Partners partner. He's president and CIO of GTIS Partners. And coming up here, we're going to go to the Treasury Department for a reaction to today's jobs numbers from Deputy Treasury Secretary Wally Adeyemo. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and radio. I'm David Weston. We got those jobs numbers, and at least the way I look at it, I'm not sure the equity markets like them very much. So we're going to turn to Kriti Gupta now to tell us what the reaction has been to these numbers.
Yeah, so 263,000 new jobs added in September. The estimate was 255,000. It's only a difference of about 8,000. That isn't, to me at least, on the surface level, going to be a gigantic beat. Nevertheless, it was enough to send the stock market tumbling to the tune of, drum roll please, 2.3% declines here, and the NASDAQ about 3.3% as well. And the idea here is quite simple. I'm going to use terminology going back to some of the phrasing we used in 2020. Good news is now bad news for the stock market. So the idea here simply being it shows that there is still a lot of job momentum, a lot of strength in the labor market that the Federal Reserve is going to have a very hard time kind of putting some slack into. And that's something that the stock market is pricing in right now. And the bond market, might I add. 385 on the 10-year yield, only up about 3 basis points. It's paired a little bit of the spike you saw off the data, but still nothing to scoff at.
But the dollar necessarily goes up.
It does. It follows the yields picture, but it's kind of come full circle. So now you're looking at a Bloomberg dollar index that's only up about 0.2%. And you would think when you see that kind of volatility in the dollar space, you would have the ripple effects into the commodity market. And right now, it's kind of a split picture because you're having a literal inverse move into copper, into gold, but not into crude, which is where you see the biggest move. Brent crude at a 98 handle, an almost 5% move on the day for NYMEX crude.
Okay, in the meantime, one of the big stories here in the United States are chips. We've been talking about not having enough chips for the longest time. Now maybe we have too many.
Yeah, well, we were just talking about commodities. That was the macro trade du jour, but so was the chips trade. Essentially, in 2021, if you were worried about inflation, the supply chain crunch, all you had to do was buy a basket of commodities, buy some chip stocks, and you were set. And even now, you can see that in some of the winning hedge fund strategies. That's been the strategy they've used. But overnight, David, we've got some not so great numbers coming out of Samsung. An operating margin that's dropped by, get this, 32%. Wow. Advanced Micro Devices talking about a $1 billion sales miss. The idea here simply being that there is going to be weakness in a market that's very cyclical and also dealing with a lot of geopolitical tensions as the Biden administration looks to restrict the export capacity.
It's an important point, more on the demand side than the supply side.
Well, I think it's a mix of both.
People are going to need as many microchips. Right. Thank you so much to Kriti Gupta. You can catch Kriti again at 1 p.m. Eastern Time, which she'll be anchoring Bloomberg Markets. Coming up, Deputy Treasury Secretary Wally Adeyemo on today's jobs numbers and what the OPEC Plus decision on Wednesday means for U.S. sanctions on Russia. That's coming up next on Balance of Power, and we are on Bloomberg Television and on Bloomberg Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. All program long, we've talked about those very important U.S. job numbers that came out this morning. Earlier today, my colleague John Farrow talked with the Secretary of Labor, Marty Walsh, about the numbers, and this is what the Secretary had to say.
We need to continue to bring down the inflationary pressures that people have. Certainly, what OPEC made a decision on this week to do was not helpful to us. The president was disappointed. We're disappointed as administration, but we need to continue to bring down those pressures. I mean, I think that, I had a long conversation in my office today. I certainly don't want to see the unemployment number go up. I like to see people working.
That's what the Fed is forecasting. Some people say that's the objective. How are you preparing for the pain that they're forecasting? And what can we do on the supply side when it comes to things like immigration?
Well, on the unemployment, we were talking for the last 3 months about seeing those numbers go down. And in the year 2022, we've had about 440,000 jobs per month. We're still seeing 263,000 people going to work today. This month, I should say, last month, we're still seeing those numbers going on. So I think that that's something that is important, that we continue to put those gains. We still have job openings. People are still looking for work. Obviously, we'd like to see the participation rate a little higher. I mean, that number went down a little bit this month, I think 0.1%. So we have to see what's happening there.
Clearly, the employee over the last couple of years is getting some leverage it hasn't had for a few years, a number of years, maybe even decades over their employers. You brokered a deal with unions in the last few months with freight rail companies, the 12 unions. I understand 4 of them have ratified the deal, Marty. Secretary Walsh, are you worried about the other 8?
No, I'm not. I mean, they're out there explaining, when I say they, the union leadership now and the bargaining committees are out there explaining to the members what's in those contracts. It was a very painful negotiation, not what I had, but leading up to me. 2 years of negotiation with really no movement. And I think that there's explaining to do in these contracts. And I look at these contracts, they're good. They're a good contract. I mean, it's 24% over 5 years, healthcare freeze cap, work rules change. It was a good contract for the employer and employee as well. So hopefully we can get the rest of these ratified in the next, I think, next 6 weeks.
In the Rose Garden, the president said this: because of this labor agreement, those rail workers will get better pay, a 24% wage increase over the next 5 years, improved working conditions, peace of mind around their health care by capping the cost that workers will have to pay. Have the port workers on the West Coast, Secretary Walsh, asked for the same conditions?
No, I mean, I don't know. I don't know what they're asking for wages and benefits, but certainly those are all the conversations that are generally on the table. A little different negotiation. The West Coast port negotiation is a very fluid conversation. That both sides are at the table. They're both having conversations. It's a longer process than I anticipated, but that's just historically the way they've operated. They kind of take one segment at a time. I stay in close contact with both the employer side in the unions on the West Coast port, and both sides have expressed to me that they're still moving forward. There'll obviously be sticky issues that'll pop up every now and then, but nothing that's making me be concerned that I have to have a 20-hour meeting in my office about.
That was Labor Secretary Marty Walsh talking to Bloomberg Television earlier today. And we go now from the Department of Labor over to the Department of Treasury. And we welcome Wally Adeyemo. He's Deputy U.S. Treasury Secretary. Mr. Deputy Secretary, thank you so much for being with us. I know the job number one, if I can put it that way, for the White House and for the Treasury is to get inflation under control. Do these jobs numbers give you any solace about getting inflation under control?
Well, it's great to be with you again. And I think that the job numbers are positive for the U.S. economy. It demonstrates to us that we continue to have momentum in the U.S. economy, and that the way we think about this is we look at all the data from this week. And we've seen data that has indicated to us that while we're continuing to create jobs, we're also making progress in terms of what is the president's, you're right, number one goal, which is bringing down the costs that the American people have to pay. And we think that we're able to do both of those things at the same time. As you know well, the Federal Reserve has a primary responsibility for dealing with inflation, but recently Congress passed the Inflation Reduction Act, which is going to help bring down the debt, but also make a series of investments that will expand the capacity of the U.S. economy going forward. So we feel confident about where the U.S. economy is now, and we know that over time we're going to be in a position where we'll see inflation come down as we continue to see momentum in the economy.
We'll see, but I guess I'm a little impatient to say, when is that will? When will that happen? The Inflation Reduction Act, when do you expect that to really affect inflation? We see right now, for example, wages up 5.0% year over year, and there are some people who say because of the ECI numbers, it's going to keep going up for a while.
So you're right to say that year over year we've seen those wage increases, but over the last few months we've seen that steady to a more sustainable rate. And I think what we're seeing in the data is that things are moving in the right direction. We're continuing to create jobs for the economy while we're starting to see things like the number of job openings reduce, all demonstrating that we're heading towards what we'd always predicted, which is a sustainable rate of economic growth in the economy while inflation and the cost pressures in the economy come down. We've seen the price of gasoline, for example, come down from the high levels that they were over the summer to lower levels now. And as the president has made clear, we're going to continue to take steps to make sure that not only the cost of gasoline come down, but the cost of things like prescription drugs, which have been too expensive for too long, also come down, which was provisions that were included in the Inflation Reduction Act.
Beyond your responsibilities for the economy overall, you also are involved at the Treasury Department with the dollar. The dollar is really, really strong. We've always said we like a strong dollar. At the same time, that has a cost as well. If not for the United States, for a lot of the rest of the world, and particularly some of the emerging markets that you know well. Are you concerned about what this means for some of the emerging markets around the world who are really struggling with a lot of increased prices, made worse by the strong dollar?
One of the most important traditions we have at the Treasury Department and the government is that only one person in the government talks about the dollar, and that's the Secretary of the Treasury. So I'll refer you to what Secretary Yellen has said about the dollar. But what I'll say about the global economy is that it's evident that today investors and capital from around the world want to come to the United States because of the underlying strength of our economy. When you look at the U.S. economy, we have created a historic level of jobs, and we've seen a historical rate of GDP growth in the United States over the course of the last 2 years. And now we're settling into a more sustainable level of growth going forward. But I do think that the three pieces of legislation that we've passed over the last 18 months, the Bipartisan Infrastructure Act, the CHIPS Act, and also the Inflation Reduction Act, give investors from around the world confidence that the U.S. economy is not only going to continue to grow over the next year or two, but over the next several decades. And when I am talking to investors around the world, and I was recently just in India, all of them are thinking about how they can make investments in the United States. because of the growth opportunities that are here. And we want to make sure that we continue to do that. And we want to make sure that we do that mindful of the fact that we need to be able to sell things abroad. And that's why we care deeply about how well emerging market economies are doing. But I'd say that the greatest headwind that we face here, but also they face around the world, is heightened energy and food costs that are a result of Russia's invasion of Ukraine. And we're doing everything we can to try and mitigate those increased costs, because we know that doing so is not only important to us, but important to the rest of the world as well.
No question that energy costs are hurting the entire world, the United States, but really Europe and also the emerging markets as well. What OPEC Plus did this week did not help on that score at all. Did that take some of the sting away from some of the sanctions that you're responsible for imposing on Russia?
So what OPEC Plus did this week was disappointing, because we don't think that it was in their economic interest or in the economic interest of the rest of the world. Fundamentally, what OPEC Plus has promised is that they would make sure that the global energy market is well supplied. The reality, though, is that because of the actions we've taken domestically, we're better situated to mitigate the cuts that they've announced, both because production in the United States is up, but also because the president has authorized the release of the Strategic Petroleum Reserve. When it comes to the actions that we've taken against Russia and Ukraine, as we've talked about previously, we have two objectives. One is reducing Russia's revenues, but two is making sure that their military industrialized complex is unable to get access to the semiconductors and the materials that they need to actually wage their unprovoked war in Ukraine. On the second front, we've taken actions that have shut down their top two tank producers and taken away the semiconductors they need to build precision missiles. And we're continuing to take actions that are leading to them reducing their revenues over time, including working with our allies and partners to allow Russian oil to flow using G7 services, but to make sure that they are at a lower price. And as you know, David, we in the United States and Europe have decided that as of December 5th, they will no longer purchase Russian oil, which will mean that this cheaper Russian oil will be available to developing economies, which, as you pointed out earlier, have been hit the hardest by the increase in energy cost and food costs over time.
I'm not sure, Wally, that anyone really knows how the price cap, the so-called price cap, is really going to work in practice. But does the OPEC Plus decision actually interfere with that price cap? Does it make it more difficult for that to have teeth?
So, David, as I've said, the two goals of the price cap is to make sure that we're keeping oil on the market. And ultimately, Russia should feel free to sell their oil using non-G7 services. What the price cap does is it provides them with an opportunity to continue, if they're unable to find enough ships or services to sell oil using non-G7 services, they always have the option of using G7 services as long as the oil is sold under a certain price. Our goal overall is to make sure that oil remains on the market, to make sure that it's well supplied. And we think that by doing that and by creating the price cap mechanism, we're in a place where we'll reduce Russian revenues over time. And we think that that goal is something that we've already achieved. And you've seen that in terms of some of the reporting, even by Bloomberg, about Russia offering lower prices to customers in order to lock in longer-term contracts in anticipation of the price cap.
We've already heard from some people at the White House, not the Treasury Department, at the White House, that they were somewhat surprised by the result in the OPEC Plus. Is it causing the U.S. government, including the U.S. Treasury, to rethink our energy policy in any regards? Because, as you know, many in the oil industry say, if you allow us to drill more, if you really free us up from the permitting, we will produce more oil right here. We don't have to rely on Saudi Arabia. Is there any thought we might rethink that a bit?
So, David, we have for a long time been calling on energy producers of the United States to produce more, and we're seeing that happen. We're on pace right now to have produced historic levels of oil domestically in the United States by next year because of some of the actions the president has already taken, and we're hoping that those producers will continue to produce. And the Secretary of Energy has made clear that if energy producers have ideas as to what we can do to create a better permission structure for them to do that, we're willing to do it. But in addition to producing now, which we think is essential to making sure that American people have energy security, and we continue to see gas prices go down so that they have more money in their pockets, we're also investing a great deal in thinking about the future and how we build a more clean, energy-dependent economy. And that's what we've done with the Inflation Reduction Act, where we're looking to expand the capacity of the United States. And this week, we announced that we're looking for comments from businesses and from individuals about how we implement the tax provisions of the Inflation Reduction Act in a way that create incentives to build out that clean technology future that will mean that we're less reliant on fossil fuels over time.
So I actually have a question from a viewer that I should pass along to you because they want the question asked. If in fact we're at historic levels right now, why do we need help from the likes of Saudi Arabia?
Well, David, as you know, oil is a global commodity and the price is set globally. And in order to make sure that when supply is decreased from one source of that, it has an impact on the price that all of us pay. So our goal is to make sure that the global market remains well supplied. In addition to seeing increase in production here in the United States, we've been encouraged to see an increase in production in places like Canada, and we're hoping that we'll see an increase in production around the world, which will bring down prices here in the United States, but also bring down prices globally, because ultimately our goal is to make sure and to be focused on bringing down prices in America for American consumers, but we also know that ultimately America wants to be able to sell things to the rest of the world. That means that we want to make sure that there are healthy economies around the world, especially in developing economies that have been hit the hardest, both by OPEC's recent decision, but also by Russia's war in Ukraine.
Okay, Mr. Adeyemo, thank you so much for your time today. Really appreciate it. That's Wally Adeyemo. He's Deputy U.S. Treasury Secretary. Coming up, President Biden warns about risk of nuclear Armageddon. We talk with James Jeffrey, former U.S. Ambassador to Iraq and to Turkey. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. President Biden visited New York yesterday and reportedly at a fundraiser warned that President Putin was really risking perhaps nuclear Armageddon, to use his phrase, because of some of the veiled threats he's been making. We turn now to someone who's an expert in diplomacy and national security as well as the region. He's James Jeffrey, visiting fellow at the Washington Institute for Near East Policy. Mr. Jeffrey served as U.S. Ambassador to Iraq, Turkey, and Albania, in addition to senior positions at the State Department and at the National Security Council. So, Mr. Ambassador, thank you so much for being with us. What do you make of these remarks? Is there really a risk? Is it as big as it was during the Cuban Missile Crisis?
It's not as big as a Cuban Missile Crisis because there people were ready to fire missiles at each other's homeland. Nonetheless, if President Putin, as he has threatened, uses what we call tactical battlefield nuclear weapons against the Ukrainians, and that's the threat that he's put on the table, that would represent a crossing of a threshold that we haven't seen, obviously, since 1945. It would be a very, very bad thing. It would not necessarily lead to Armageddon because the United States almost certainly would not reply with a nuclear strike. And I don't think we would use even military forces to strike conventionally against Russia, because what would be the legal basis for that? This would be an escalatory ladder. I think that while President Biden has promised a catastrophic response to what Russia did, I think it would be more in the diplomatic and political realm, and we would give more longer-range missiles and other systems to the Ukrainians. I do not think that this is necessarily going to escalate, but it would be a very, very bad thing from many standpoints if Putin did it.
Well, staying in the diplomatic realm, one diplomatic initiative was President Biden going over and visiting with Crown Prince Mohammed bin Salman in Saudi Arabia. Let's be honest, in part to get them to really loosen up a bit on the oil production, and now we have OPEC Plus going exactly the opposite direction. What's your assessment of what happened there?
Several things. One is the Saudis have been focused, and many of us have talked with them, on short-term gains to build up their overall stocks for the time when oil is less in demand. And they saw oil dropping towards $80 a barrel. They want to get it back up to 100. So they went together with Russia and other countries to come up with this 2 million barrel cut. It probably will not be as much as 2 million barrels because some countries have already cut. Some countries simply will not drop more. But nonetheless, it will push oil prices up in the United States. Not dramatically, but enough to make the Biden administration very, very unhappy, because what they had hoped was more understanding on the part of the Saudis, the Emiratis, and the others who made this decision, not to form a pact with Putin, of all people, to undercut us and the rest of the world.
At the same time, what should the U.S. response be to this? Obviously, it looks like something of a rebuff to President Biden. What's the proper U.S. response? And frankly, in fashioning the response, should we regard this as something personal, or is this just business?
It's both. It's both business, as I said, because the Saudis look at the bottom line, and frankly, if demand remains high and the offer is supply is reduced, prices go up. and that's good for them in the short term. It's also personal because, first of all, the Saudis are unhappy with the Biden administration's own policies on energy, but more importantly, they're not sure that the Biden administration will do the necessary against Iran in the region. Iran's allies, the Houthis, in the war that they're fighting in Yemen against Saudi Arabia, for example, have just refused to renew a ceasefire. We see the Iranians advancing in Iraq, including a drone over Erbil in the north that a U.S. fighter plane had to shoot down a few days ago. The Saudis look at this and they don't think this administration is committed to stopping Iran in the region. So they're hedging their bets by maintaining this at least oil pact with the Russians.
Okay, Mr. Ambassador, thank you so much for your time. Really appreciate that. That was helpful. That's James Jeffrey, former U.S. Ambassador to Iraq, Turkey, and Albania. Coming up, we're going to go over the big debate last night in Arizona between Senate candidates Mark Kelly and Blake Masters. This is Balance of Power on Bloomberg Television and on radio.
I suspect President Trump would be in the White House today if big tech and big media and the FBI didn't work together to put the thumb on the scale to get Joe Biden in there.
But not vote counting, not election results.
Yeah, I haven't seen evidence of that, but I'm telling you what I think the problem is.
That was Blake Masters at his debate last night against Mark Kelly. That's for the Senate position down in Arizona. And we welcome now our Bloomberg political editor. He's Mario Parker. So, Mario, you heard Blake Masters there. I thought he was a firm denier of the legitimacy of the 2020 election. He wasn't denying it that firmly.
He was up until the point that he had to sway independent voters in the general election. It was enough to get Donald Trump's endorsement in a primary where you have to go far to the right. But for a general election, you have to pivot. The political reality, one thing that doesn't change is that you have to pivot back to the middle. And so we saw Blake Masters attempting to do that last night with the debate against Mark Kelly.
At the same time, as I understand it, Blake Masters really went after Mark Kelly on a couple of issues, which is that southern border and immigration and also inflation. Did he score points?
Yeah, he did, but I mean, that's expected, right? You know going in that he had to put up some points pretty quickly, that Mark Kelly's biggest weakness, particularly in a border state like Arizona, is going to be the Democrats' handling of the southern border. It's going to be, we had a series of stories here at Bloomberg looking at where inflation runs the hottest. The Phoenix area is one of those places as well. So that's not a surprise at all. Right. So while Blake Masters put some points on the board, Mark Kelly put some points on the board as well. Mark Kelly, it's simple math, right? So if Mark Kelly is up about 10 points, they both put 5 points up on the board. Mark Kelly still is up 10 points.
Well, that's the question. He's the incumbent, Mark Kelly is, and I think he has more money last time I checked as well. So I assume that Blake Masters has to do more than just tie him at this point.
Yeah, no, absolutely. And that's the other audience that Blake Masters was trying to kind of woo, right? We've got like around 4 weeks left before the election. He needs money bad. He had to put some points on the board and get the attention of donors who may be willing to write him a couple of checks in the closing days of this race. But as of right now, Democrats feel, based off the sources that we've spoken to, Democrats feel really good about Arizona. Now, there's some problem areas in other places, but Arizona is one of the places that they point to as a bright spot.
And we're going to be having you back to talk about some of those problem places as we get closer to those midterms. Thanks so much to Bloomberg's political editor. He's Mario Parker. Check out the Balance of Power newsletter on the terminal and also online. Coming up, Balance of Power continues on Bloomberg Radio. In our second hour, we're going to talk to former HP CEO and presidential candidate Carly Fiorina about how the U.S. should respond to that OPEC Plus decision, cutting production by 2 million barrels a day. This is Balance of Power on Bloomberg Television and on radio.